Hello again, this is Alex with MasterChartsTrading.com, and this is Market Recap for Friday, April 30th, 2016. We have quite a bit of information to cover this week, so I'll be moving quite fast. Stocks ran into resistance. Technology sector really is underperforming the general market. So far, the New York Stock Exchange Composite managed to avoid a support break. And also, the bullish case for stocks actually has improved, and I'll show my custom market breadth index to support that argument. The junk bond market also shows some resilience, and this is possibly adding to the bullish case for stocks. However, bonds have held support and bounced throughout the week. The dollar came under pretty strong selling pressure and now is at critical support. And of course, the commodities are taking advantage of the cheaper dollar, and gold miners are making fresh 52-week highs. We'll look at oil and natural gas as they are both advancing in a choppy manner. All right, this is S&P 500 ETF SPY on a daily time frame. So very strong rally of the lows in February. We went through several resistance levels, went through 200-day moving average, and now it seems that we are running into resistance at all-time highs. Well, now this is all-time highs. The reason is because S&P 500 ETF SPY adds this graph has the dividends added back into the price. So this is about 2% higher than the actual underlying index. Nevertheless, looks like we had sort of a bearish engulfing right here, and then continued lower. Now, this Friday, looks like we were gonna close even lower towards the end of the day, but looks like the bulls came in and pushed the prices higher. Now, this candle, I mean, you can argue that this is a hammer candlestick. Ideally, this should have a close above the open, not the opposite. So this doesn't look very strong to me, and most likely this level will be taken out on the downside. Now, anything is possible, and this market has been pretty resilient actually. So we could just turn around and make an all-time high. Further down below, we still see several. We still, for example, here see a divergence between the indicator, and this is a intermediate term Bread's momentum oscillator. It's kind of like an oscillator of the advanced decline line. You can see that it made a lower high while the index itself made a higher high. So maybe this divergence is already coming to fruition, and looks like we're seeing some downside pressure. The picture didn't really change much from last week. I showed the exact same chart last week, and we had not broken out above this level on unbalanced volume, and we have not broken out above this level on the advanced decline volume line. You can see the advanced decline line itself has indeed broken out. So volume is lacking still on this advance. This is the actual underlying index, the S&P 500, going back about a year back. So here we have, you can see that this high here that we just made is below this high and this high here. And the reason being, like I explained, is because this is an actual index without the dividends. This ETF SPY actually has the dividends added back into the price. Up here is my proprietary market breadth index indicator. You can see that it entered into the bear market September of last year, and since then I have not seen it cross above this green line, which would indicate that we're now in a bull market. We have indeed improved, and it looks like we're now about halfway to the bullish goal, but we have not gotten there yet. And I've seen in the previous examinations of this indicator, it sometimes comes up very close, but then it just collapses afterwards. So I'm gonna wait until this indicator actually becomes bullish, and then I'll be looking for buying opportunities. Down below, we still see some bearish divergences from last week. I don't think they have played out fully just yet, and I think we may still see quite significant downside, especially if we take out like these levels here and below the 200-day moving average. Then maybe we get down to the February highs here, and if we don't hold there, we could easily retest February lows. Of course, if we don't hold there, then we could have some more significant downside even afterwards. So we have improved in the S&P 500 stocks above the 200-day moving average. You could see it's now firmly in the bullish territory. Okay. Now, what's interesting about this pullback is that the technology is really leading on the downside. And whereas if I just showed S&P 500 ETF SPY came up and made a all-time high, the QQQ did not, and it is quite a ways off from the all-time highs. It did manage to close this gap down from the beginning of the year, and then sort of traded sideways and then gap down here on last week, continued lower. So throughout this week, we pretty much had non-stop selling. Again, this looks sort of like a hammer candlestick, but ideally hammer candlestick should look like that, where you have a close above the high. So or like that, maybe close above the high. So that would be better. But we'll see if this pans out or not, if this support level holds. I mean, there's really not much as far as support. Maybe there's support at 103 here, but I think the stronger support is, maybe even further down below. I mean, we're basically already to the February highs. So QQQ is really leading on the downside, and there were divergences here. You can see that same indicator, market breadth momentum oscillator. It was pushing lower while the index was pushing higher. This indicates that very less and less stocks are participating in this advance. Next, I'll show XLK, which is actually quite similar to QQQ itself, but I think it's even more heavily weighted towards Apple. So it did manage to make an all-time high, but then again, same thing, gapped down and sort of unraveled. And now we're basically down to the 200-day moving average, and here at 41 and change is the February highs. Again, if we break the support, we could easily re-challenge the February lows. Further, I wanted to show in the technology sector is the Broad Semiconductors Etf. I think this is a better measure of the semiconductors universe versus the other ETF SMH, because it is very broadly diversified. This XSD is very broadly diversified. Same thing here, we see a gap down and a continuation lower, and actually a close below this low here as well. So overall, technology sector is under some strong selling pressure, and we'll see where this is leading. This could be, some would say, oh, this is an opportunity to buy. It's possible. Alternatively, this could be like the beginning of a market rout. This is a very broad measure of the United States stock market, the New York Stock Exchange Composite Index. You can see that it is pretty far away from the all-time highs as compared to S&P 500. And this is probably because the small caps are weighted pretty heavily here as well. Now, I showed these divergences last week. You can see, for example, here in October, we had a divergence versus the indicator. Looks like we have the same divergence right now, and this is the same thing as a breadth momentum oscillator. I think it's a very useful indicator, actually. So it looks like we have a divergence that potentially could be already playing out, as this week we had some selling. Now, you can see that the close on Friday did not close below Monday's close. So this would have been even a worse looking chart if the close was below this Monday's close. For now, it managed like a similar fate to QQQ, and it's managing to hold up better than QQQ. I wonder if it will, how long will it continue? Now, again, similar things here with S&P 500. Looks like we're lacking volume. So, whereas the advanced decline issues have indeed broken out to the upside, the advanced decline volume and the on-balance volume have not broken up to the outside. And also we have breadth divergence here in the percentage of stocks above the 20-day exponential moving average. Now we have improved indeed in the percentage of stocks above the 200-day exponential moving average and in bullish percent index. So this could be a it could be interpreted two ways. One way is that it is improving. The other way, I see that currently we are overbought after this really large move. We're at resistance and looks like we have divergences in the various indicators. So a pullback is certainly in the cards. This is S&P 500 on a weekly time frame. So each of those candlesticks represent 1 week's worth of activity. And here we have an all-time high here last May. And since then, and this is just the actual index again, since then we had a series of lower highs and a series of lower lows. And this is a definition of a downtrend, a series of lower highs and lower lows. So far, this high, which we put in last week, was below this high and below this high and also below this high. So for now, I'm treating this as a downtrend in security with series of lower highs. Today's, rather this week's action was almost a bearish engulfing pattern. If the open was a little bit higher here, we would have engulfed the real body of the previous week, but we didn't, so open was a little lower. It's almost a bearish engulfing. So I cannot say that this is a bearish engulfing, but it certainly doesn't look like a very bullish candlestick to me this week. So if we do get continuation, this area rather around here at 1975 to 2000, I think there's quite a bit of support here from the various bottoms here and also the broken support, another broken support here. So there's quite a bit of resistance or rather support here in the 1975 area. So if we do get a pullback, this would be the like a logical area to have maybe like a small rebound possibly. Again, if we take out this level, easily we could retest February lows and the lows from the beginning of this year. And then again, if we take out that, we could continue significantly lower after that. This is a market breadth index going back to 1976 in the upper part of the chart here. And as I explained, it shows whether or not S&P 500 is in a bull or a bear market. So you can see here there was an entry into the bear market. At this point in 2003 was entry into the bull market right here. In 2008 we had a bear market and then a bull market to start in 2009. Now for now I'm still thinking we are in a bear market that started in September of last year. And we haven't indeed improved. You can see that the indicator is now at 3, but like I said before, if I look at some historical examples, we had precedents like it would go to even 4 and then would just roll over and continue down. So for now I'm treating this as a bearish security, S&P 500, and I'm looking to short and not to go long just yet. Briefly, this is junk bonds ETF, which is a high yield corporate bonds. we bottomed out here in February together with the stock market, and went on a strong rally. Now, junk bonds have very high correlation to the general market, the S&P 500. You can see that it pretty much stays in a positive territory all the time. So, but what's you could look at it as an advantage is that junk bonds are generally speaking less volatile than the stock market. So you could also use junk bonds as a proxy to trade stocks, in a sense of you could use similar signals but at a lower volatility. This is a much lower volatility fund. And the interesting thing is junks is actually surprisingly resilient. You can see that it is pushing higher, and like for example, S&P 500 on Friday closed lower than it opened, and junk bond actually closed higher than it opened. So maybe this is a sign of improving in the general market as well, and I'm watching junk bonds very closely to see if I get any more clues about the direction of the general market. So for now, junk bonds to me are still bearish, and this is a bear market rally. But it's possible that they become bullish, and that would certainly be helpful for the general market as well. All right, that's it for stocks. Let's move on to bonds. Okay, this is TLT, the long Treasury bond ETF. I think this is a very bullish chart. We had several breakouts here, a support held, a rebound. Now, the only thing here I'm seeing is we did not take out this high. So this is a concern because we tapped out below this high. So right now we have two lower highs. So far I did not see a lower low. In fact, this low here this week is a higher low than this low here in May. And we so far rebounded. And this actually makes sense because bonds and stocks usually are quite negatively correlated. So if stocks come under further selling pressure, bonds are certainly going to appreciate, most likely going to appreciate in price. This is a long-term chart of TLT. This is going back 3 years, and each one of the candlesticks is 1 week's worth of activity. On this chart, I think we have a giant cup and handle, and now we're drawing out the handle. So, unless we break the support here at 126, 127, which is actually quite important support. So if we break down here, we could easily correct to maybe 123 level or possibly even 116 level. So far it hasn't happened yet, and if we do hold support and continue higher, we could break out above this 134 level. If this does happen, we could see this entire pattern duplicated on the upside. So this is about 20% depth of the pattern. And this would obviously be immensely bullish for bonds. By extension, this would be quite bearish for stocks. So we're sort of at an important support. We'll see where we go from here. The more diversified bond funds, AGG, are actually already very close to all-time highs. And this correction that I showed on TLT, which was quite deep, on the AGG, it barely registered. So this is a more diversified bond fund, and there's lots of corporate bonds in this ETF. Very strong looking chart. We had several breakouts here and all-time high, and I think we're challenging the all-time highs again. And the longer term chart, this is a weekly chart of the same security, AGG, going back 3 years. Looks like we already had a breakout above this, big, maybe this is a bullish wedge pattern and continuation to all-time highs, and we're kind of trading next to all-time highs. This pattern was 3.4% deep, and so far we have not had a similar duplication on the upside. And you can see on balance volume is actually quite bullish and confirming this breakout as well. Now, if you trade commodities, gold in particular, you probably should be paying attention to the price of the dollar itself. So the dollar index, and this is a daily time frame going back a little bit over a year. We had a major breakdown here on Friday. In fact, it was already quite weak on Thursday. Actually, the entire week was just non-stop selling. So the dollar is certainly under pressure. We cleanly, this Friday we took out this support level at 93 and change, or 93.80 or so, 93.50, and we are down to critical support. And this support is, from the lows here back in 2015. If we take out the support level, next chart I'll show, we could see some more significant correction to the downside. Part of the reason for this whole, selling of the dollar is the Japanese yen. You can see it made another 52-week high. In fact, here's a chart of US dollar versus the Japanese yen. Japanese yen is clearly a winner here. You can see a very large red candlestick, and followed the next day, took out this level. And last week I mentioned maybe this was a bear trap, but clearly it wasn't. We just came right back and continued selling of the dollar, and Japanese yen is appreciating. And this is all because the Bank of Japan failed to deliver more quantitative easing. So it's pretty convoluted thinking, but there it is. Long-term chart of US dollar. This still could be a cup and handle, but now we're basically to the bottom of this cup and handle pattern. And if we take out this level at $92.50, $93, we could correct back down to the breakout level. So this is pretty much a critical support here, and if we take out this level, nothing good will happen to the dollar index. Some people say that's a good thing. If you trade gold, you just have to kind of keep it in mind, because gold and US dollar pretty much move in the opposite directions. And now we're moving on to commodities part of the presentation. This is gold, daily spot price. Strong rally, you can see it. This is multi-year lows, and now we're in 52-week highs. So, exactly as I said, the dollar and the gold are inversely correlated. The dollar weakened significantly, gold rallied. And if you trade Forex, and you can trade gold on Forex if you so desire, it's XAU/USD. So USD is losing, XAU is winning. That makes perfect sense. Now, 52-week highs. This is very overbought by my, from my taste. So I am bullish on gold, but I wouldn't be buying it up here. I would certainly wait for a pullback and, look to buy it on a pullback. Depending on where dollar is going, this may come soon or it may not come soon. Because if the dollar breaks support, we could see strong correction for the US dollar, as I just showed, and gold itself will most likely appreciate in price. Here is GDX, the gold miners ETF. Actually, here's another example of my proprietary market breadth indices. So this is a gold breadth index, and it was bearish until just recently, until in March we had a breakout, and now I consider gold miners to be, and by extension gold of course, to be in a bull market. So I am looking to buy gold miners and gold itself on a pullback. This is over 100% move. So we had 12, it was at $12 at 12.40 here at all-time lows, GDX. and then now we're at 25. So this is over 100% move. Basically, no matter how you slice it, this is overbought. Most likely we'll get a pullback at a certain time in the future, especially if the dollar weakens. Excuse me. Down below here we have various breadth indicators for the gold miners. This advance is being confirmed by gold miners advance decline line, advance decline volume line, on balance volume, and by the bullish percent index. And of course we are making new 52-week highs as indicated by the new highs new lows indicator. So overall GDX and gold are looking bullish, but ridiculously overbought. And this is oil, West Texas Intermediate spot price daily. So oil was able to punch above this resistance level here at $43 and then continued higher. Possibly this is because of the weaker dollar also. It's difficult to say why. Maybe it's because of the production cuts or oil rig counts being down. I'm not really interested in buying oil on the long side, but maybe it'll top out around $50. Actually, next chart I show a longer term chart. This is a weekly time frame going back 3 years. There's a bunch of bullish divergences here as oil pushed lower, the indicators pushed higher, and you can see that it was able to close above this resistance level. Now further up here we have resistance around $53, so from these peaks here, so this is pretty important resistance level. I mean, if it doesn't fail here, I can't really see why would it go higher unless we see some sort of a major war on top of the major war that already is going on in the Middle East. But then again, American producers can just start ramping up their production, so I'm not sure how high the prices could go. Anyways, difficult to say literally at this point. And when the chart is ambiguous, I will just avoid trading it altogether. And this is one of those ambiguous charts. Further on, we'll look at natural gas. Yeah, this is natural gas, spot price daily time frame, multi-year lows here, and a strong rebound. But this rebound was extremely choppy. You can see how choppy it was. Breakout, and possibly a rejection here at the 200-day moving average and at this resistance level. So if you were able to catch it just right there, then you would have probably hit a nice gain on the short side. It's kind of hard to make much of this chart. Again, this is sort of an ambiguous chart, so you can see that we had a rebound of the lows and we took out actually two important resistance levels. If you count this one, possibly 3 resistance levels, and now we're possibly going to re-challenge this resistance again. Well, we have to pass this resistance first because we already were rejected there once. Unless we completely fall apart, we could attempt for the $2.50 area. And next chart I show again why that area is important, and this is a weekly time frame of natural gas. You can see that $2.50 is important because there were several events happening at that area, several touches, a breakdown, a rebound attempt, failed rebound attempt. So there's quite a bit of activity going on in the $2.50 area. If we do take out that level, most likely I would consider natural gas to be in a bull market again and look to trade it on the long side. For now, it's kind of in between, in no man's land, so to speak. That's it for this week's recap. Thanks for watching and have another great trading week. Please stay tuned on how to find us on the internet. Thanks. Bye-bye. So I wanted to show you how to find us on the internet. Please go to MasterChartsTrading.com. We do have a trade alert services that are now active. Please consider subscribing. You get 3 weeks free trial and it's only $24.95 per month thereafter. You get access to my charts, exactly what I'm buying, exactly what I'm selling. I have an internal blog. Also, I have several videos that have to do with trading and various aspects of um, risk control, as well as just the psychology of trading. So please do consider signing up. The subscribers are getting really good results, I think, and I'm getting some very good feedback. I have a performance section here where I post the actual portfolio percentage change. The inception date was in 2015 October, so it's not a lot of history yet. And there's some backtesting results that I feature here as well. The blog, of course, is where you'll get this information, and there's a video section where I separate them out for easier access. Click on the social page, and here we have a link to public charts page where most of the charts that you're seeing in this video are going to appear. You have Twitter, Facebook, YouTube, stacked with accounts. You can find us there as well. If you subscribe to our mailing list, you'll get a special price for our trade alert services. That's it for watching. Thanks for watching, and have another great trading week. Bye bye.